Okay, well, thank you very much, JP. It's an absolute pleasure to be with everybody this afternoon, and thanks very much for the previous presenters for laying down the foundation for my presentation this afternoon. So as the title slide suggests, we're going to be getting tactical with your covered call strategies. As always, in an effort to satisfy our legal and compliance departments, we want to make sure that everybody does truly understand that the information that's being presented here and of course throughout this options education session is for educational purposes only. And we want to make sure that people recognize that the options market, not unlike any financial securities market, does have its risks. And as illustrated throughout this afternoon, different strategies do carry with them different risk profiles. So just make sure you know those risk profiles before you actually move forward and start executing in your live account. So based on JP's introduction there, we have a lot to cover within a very short period of time. And I know Tony had referenced the content to, in the process of learning options to be a little bit like sort of trying to digest water through a fire hose. I'm hoping to really distill things down a little bit more than that with this presentation by focusing simply on one particular aspect of trading options, which is selling or writing call options. So again, as I think Tony mentioned at the beginning, or sorry, Ed mentioned at the beginning during his presentation, the covered call writing strategy tends to be the most common strategy that investors start off with. So I want to first start out with a bit of a general description of the strategy itself, but I want people to recognize that this strategy is not just simply about buying the stock and selling any old call. You really need to step back and consider what your investment objectives are. And then subsequently, once you do that, you'll recognize through understanding, again, strike price selection, expiration date selection, underlying volatility of the stock, volatility of the options contract, that you can actually get quite strategic with your strategy selection. So we're going to take a look at considering some, various objectives that you might have as an investor. Talk a little bit about trade execution, so the mechanics of entry and exiting, as well as rolling your options contracts. And trouble with this industry sometimes is you have to deal with a little bit of technical jargon. So just want to sort of explain what we mean by rolling. And then we'll take a look at just a couple of examples around how we might use the covered call strategy, get a little bit more tactical with what we're doing. So, and again, this was touched on earlier on this afternoon, so I don't want to dig too deeply into the basics here, but really the covered call strategy is quite simply about buying or simply already owning the underlying shares and then selling a call option against those shares where you're basically getting paid up front to essentially take on an obligation to deliver those shares at a specific price. And that obligation is valid for a specific period of time. So hopefully by the end of this session here, you'll have a better idea as to why you might select a specific strike price to meet a certain objective, or why you may want to consider a specific expiration date to consider as part of your strategy. Now, I talked a little bit about risk reward profiles of option strategies. So what you'll see down in the bottom left-hand corner there is the risk reward profile of a covered call. A picture's worth 1,000 words, and I think this is a very important one to consider. What you'll recognize here is that we have a limited upside with this strategy, but we have, in a sense, an unlimited or unidentified downside with this strategy. So what we want to recognize is that the risk actually lies with the underlying security. So you're going to hear me reinforce this throughout this presentation, but you really want to make sure you like the stock and you're comfortable owning that stock, as part of the covered call strategy. So this strategy starts with the stock, and then you subsequently overlay the option strategy. You're not starting with the option strategy. Now, this strategy is referred to as the covered call strategy, quite simply because the obligations associated with you writing the call are covered by the ownership of the underlying obligated shares. So if you're long 100 shares of company XYZ, then you would basically be able to sell one call option against those 100 shares, and your obligations associated with delivering those underlying shares at the strike price associated with the contract are covered by those 100 shares. So again, recognize that you're going to do this strategy in 100 unit or 100 share increments. Now, your max gain, as referenced within the risk reward profile, is really your stock purchase price plus the premium received, the strike price minus the stock purchase price plus the premium received. So in other words, you cannot make any more in this strategy beyond the strike price that you have selected to sell plus the premium that you've actually generated through writing that call option. Again, taking on the obligation to deliver the underlying shares. Your max loss is the stock purchase price minus the premium received. And in brackets, you'll see substantial because, again, at the end of the day, your risk lies with the underlying shares. But the important consideration is, and this is where the strategy comes in as a risk mitigation strategy or a way to reduce volatility within a portfolio, is that every time you sell that call option, every time you collect a premium, it kind of lowers your overall cost basis of the underlying security. So if I bought the stock for $100 and I sold a call option for $1, well, my average cost basis then becomes 99. And if I can sell that option and collect that premium on a month-to-month basis, ultimately I'm going to lower that risk exposure, and I've got a little bit more buffer on that position if the shares actually, the underlying shares actually move adversely against me. So what are some significant considerations here to start off with before we get into the nitty-gritty of this? Options prices are based on the existing and expecting volatility of the underlying security. And this is where, I saw some questions around options Greeks and the implied volatility and options Vega. So recognize options are priced based on uncertainty and based on, the price fluctuation of the underlying stock or ETF. And so when you sell an option contract in the context of a covered call strategy, if you're getting a nice juicy premium for that option contract, you want to recognize that you're getting paid for the uncertainty that is associated with those shares, and that you are assuming an obligation to deliver those shares. So you want to exercise some caution when chasing premiums. And this ties back into my comment around starting with the underlying stock. Don't start with, looking to collect a nice juicy premium, because you're basically getting paid for uncertainty. Remember that your risk stems from holding the underlying security. So at the end of the day, make sure it's a good investment. All right, so what are your objectives? And again, this is where I've suggested that the covered call strategy can actually be a very versatile strategy. And of course, there are many ways to approach portfolio management. And now that goes for, whether you're a retail investor managing your own portfolio, or if you're in a situation like we are at our firm where, we're managing other people's money. At the end of the day, there are a number of different ways to use this strategy to meet a number of different objectives. And so what you want to consider first and foremost before you actually look at integrating this strategy as an overlay is, what are your objectives? Is it growth? Are you in that stage of your life where you're looking to, enhance your capital gains and just, go for stock appreciation and stock upside? Or are you looking at focusing on income generation and capital preservation? Are you an active trader / investor, or are you passive? Are you utilizing stocks versus exchange traded funds? Are you a technical trader versus a fundamental trader? Or are you a combination of the above mentioned? And I think a really important consideration here is you don't have to be one or the other. One of the ways that we approach portfolio management is we actually divide portfolios up, or our funds, into sleeves. And what do we want to accomplish with this particular sleeve within this particular investment portfolio, which means one sleeve may be focused on growth and capital appreciation. So how do we use options for that? The covered call strategy for that. One sleeve may be income generation and capital preservation. So how do we use the covered call strategy for that? So you don't have to just focus on one specific application of the strategy. You want to step back, figure out what you're trying to accomplish with the different sleeves within your portfolio, and then apply that strategy accordingly. And that goes, of course, whether or not you're a technical analyst or a fundamental analyst or a combination of both, you don't have to be one or the other. So for many of you, I have to suspect that your focus is centered around managing your investment portfolios for retirement or for some sort of savings objectives, and you're looking to try to really take advantage of option strategies as much as you can in a tax sheltered or tax free environment. And that may be, again, because you're looking to generate cash flow at reduced volatility. One of the key considerations if you're, in your retirement years or close to your retirement years, maximizing your returns for children's education. You've got a longer time frame to consider, and you just want to generate, as much upside as possible, lower the volatility in the portfolio, capitalize on capital appreciation, but also enhance income, enhance returns in some way. You want to take advantage of the compound growth, and really just at the end of the day, prevent a portfolio drawdown. So the cool thing about this strategy is that it is permissible in your registered account. So you can use this in your RIFs, LIFs, LIRAs, RESPs, RDSPs, TFSAs, whatever registered account you are managing, whether it's one or a combination of all, this strategy has its place once you understand the logistics on implementing it and have a good solid understanding of really where to apply it. The first thing you need to understand, and again, this was touched on, to a certain extent earlier on presentations, is trade execution. So I want to speak to this specifically from the perspective of being the covered call writer, because I'm going to assume that everybody already understands how to buy a stock or how to buy an ETF, a relatively, typical approach. But when it comes to entering into a position, into a covered call position, the opening trade is in fact a sell to open trade. And of course, I always say, well, how do you get out of a room? Well, you basically go out the way you came in. So if you've sold to open a position, you're going to buy to close that position. Whether or not you're looking to do that to cut losses, lock in profits, or as part of rolling the position, as we're going to touch on shortly, you're going to sell to open the position, and then you're going to subsequently buy to close. Now, what you'll see on the bottom of the slide there is just an example of a stock trading at $15 and us looking at an option contract that is expiring, let's say in November, $15 strike price, and we're looking at the last trade at 50 cents and a bid price of 45 cents and an ask price of 55 cents. Now, this also ties into one of the comments that was made around liquidity of an option contract and its implications or impact on the bid ask. So I'm actually showing an options quote here with a relatively narrow bid ask spread. The important consideration as a trader when looking at these particular fields within a trading platform is that is the market telling you, hey, if you want to get in, here's the price it will take, no questions asked. And if you want to get out, here's the price that you're going to have to pay, no questions asked. So if you wanted to get into this particular position from a covered call writer standpoint, and you were comfortable with collecting 45 cents versus being greedy and collecting 55 cents, what you would do is you would sell to open at the bid. All right. So again, that's something you have to be comfortable. Am I comfortable collecting 45 cents, over a certain period of time? And do I want to execute this strategy very quickly? Well, you're going to sell to open at the bid. If you want to subsequently get out of that position and you want to get out very quickly, well, the market is telling you, hey, you're going to pay a tax on that. And if you want to buy to close that position now, you're going to buy to close that at 55 cents. Right? So again, you want to recognize you're going to sell to open at the bid. You're going to buy to close at the ask. Now, from time to time, what you're going to recognize is that the bid-ask spread may be very wide. It's not to say that there's not a great opportunity in trading those kinds of option contracts around a particular stock position, because it really, once again, as I said, really is dependent upon the underlying stock, right? So you're going to build a portfolio with stocks you want to own. You're going to go to the options market to see if it's worthwhile overlaying a strategy. And then you're going to subsequently have to deal with the market that's being presented to you. So from time to time, bid-ask spreads may be wider depending upon trading volumes and market conditions. So you can use what's referred to as a limit order to specify your desired price. So what I'm showing here is a sell to open limit at 50 cents. So you get a bid of 35, you've got an ask of 60, and you're saying, well, you know what, it's not worth my time capping the upside for 35 cents, but I'd consider it at 50 cents. So your rationale there is to go into the market, place a limit order, and if the market maker or other market participants are interested in doing business, then that order is going to get filled, right? But you want to recognize it may not necessarily get filled because you're going in at an order that is not being presented to you. So it's going to be up to the market maker or other market participants to decide whether or not they're prepared to do business. And you know what? You may get lucky and somebody who's saying, geez, I'd like to get 60 cents for this, but God, I just want to get out of the position. Well, you know what? They may meet you at that 50-cent mark and you get the price you want. What you got to be aware of is the fact that you could conceivably end up not getting your order filled because the limit order says this price or not at all. So you may have to be prepared to make an adjustment. All right, so rolling your contracts, really simple process. Covered calls typically tend to get held until expiration, but from time to time, you may want to make an adjustment. So what you may want to do is you may want to buy to close your initial position where you're going to pay the market for whatever they're asking, or you're going to buy to close at a limit order that you are comfortable with. And then you're going to subsequently sell to open a new position adjusted to the desired strike price and expiration date based on what you're trying to accomplish. And I'm going to give you some examples here in a couple of minutes, so this will all make a lot of sense for you. So you can adjust your position by rolling. And again, that's just an industry term, which simply means you're adjusting your contract positioning. So for example, if I were to look at this example here, we've got AEM shares at $104.40. We've got 105 strike options expiring the next day. We may say, you know what? I don't want to deliver my shares at 105. I want to leave some upside. And if I hold this position through expiration based on the market price presently, if the stock's at 105 tomorrow, I'm going to have to deliver at 105 and I'm out of the position. So what you can do as your first execution here, trade execution, is you're going to buy to close that 105 strike expiring in one day. And the ask price might be $1.28. And it's $1.28 because, hey, ideally you paid maybe $3 a month ago, but because that time depreciation factor has kicked in over that time frame, this contract's been losing, based on its theta on a day-to-day basis, a portion of its premium. So ideally what you can do here is you can buy to close it at a lower cost than what you sold to open it at. And then you subsequently turn around and you say, man, I'm good with leaving $5 more upside into the next month. And then you're subsequently going to just simply sell to open that 110 strike expiring next month and collecting $3.40. So what we've done is we've rolled up to the 110 strike and we've rolled out to the next expiration date, and we've given ourselves more stock upside, and we've also given ourselves more time for that stock to move in our favor without actually sacrificing the revenue stream that we're trying to generate off of the call writing. Now, another consideration here, guys, are earnings reports and how covered calls become a real interesting consideration around earnings because of how implied volatility impacts the price of the contract. So we need to understand that implied volatility is the market's view of future volatility. This ties back into that earlier comment where options are priced based on uncertainty. And so as the uncertain date of an earnings release approaches, we want to recognize that option contracts premiums expand in general. And what that does is it increases the value of the contract. So as the option writer, we actually can capture some short-term income because of that expansion of implied volatility, which typically will decrease or contract after the earnings are announced. Now, here's just a little bit of a snapshot of what that looks like from the perspective of implied volatility, which is in gold. So that's the option premium expanding because of the uncertainty, versus historic volatility, which is the measurable, quantifiable volatility of the underlying stock. What you'll notice is that in gold there, implied volatility is expanding leading into the earnings report, which means option contracts are getting more and more pricey as that date draws near. What you'll then see is that as soon as the earnings is released, well, it's all known to the public. And so what was once unknown and uncertain becomes known and certain, and you get this contraction of implied volatility. So it's a pretty neat way of taking advantage of market uncertainty on stocks that you own, offsetting some of the cost basis and even some of the risk associated with holding that stock through earnings through taking advantage of more expensive option contracts within that time frame. And the cool thing is, if we want to look at it from the perspective of expiration date selection, you can, with a lot of option contracts, use a weekly option. So you sell the contract that's expiring within the week associated with the expiration date, and you take advantage of that short-term uncertainty as the shareholder to collect a little bit of extra premium against the underlying shares that you're holding. So what are some considerations? Again, the risk lies with the stock. It may drop significantly, which is the risk you already held as the shareholder. So that's something you've already decided you're comfortable with. The other consideration is it may rally significantly. So remember, when we sell that call option, we cap the upside. So as I will demonstrate here shortly, what happens is you ultimately end up being able to adjust the contract strike price to accommodate for that. So the considerations here from everything that we've touched on up to this point, I want to try to illustrate in a few examples here in our Let's Get Tactical section. Now, again, I recognize a lot of information flowing at you in a very short period of time. The one thing that I can guarantee you is that you're not going to get it all in one sitting. If you're anything like me, it's all about repetition and reinforcement. So again, remember, watch the recordings. You may get sick of listening to us, but I guarantee you it's going to resonate with you to the point that it'll become second nature when you're, when you're making these decisions. So let's take a look at AEM right now. Again, just an example, not a recommendation by any means. We've got AEM at the time that I was cobbling together these slides, trading at $104. I was looking at options that are trading with a 35-day expiration date. Now, remember that we can choose in the money options, at the money options, or out of the money options, depending upon what we're trying to accomplish. So in general, we may consider selling in the money options if we're really looking at hedging the position. So the highest, this is where we get the highest premium, but the lowest time value. So you're not really generating a lot of return from a cash flow perspective, but what you're doing is you're capturing a lot of intrinsic value up front, and that's going to offset the risk associated with the underlying shares for that period of time. At the money is where you're going to get the most cash flow. So that's where the time value is the greatest. That's where theta is the highest. And so this is where you're limiting the upside, but you do have the opportunity to collect a nice premium for taking on the obligation. Out of the money, upside, right? Lower premium, but you have the opportunity to generate a greater capital appreciation on the underlying shares. All right, so Expiration month selection. Now we're going to use what we call front month contracts in this example, simply because there's way too many choices here for us to consider. So front month contracts generate a higher annualized cash flow, but it's more transactional. So if you're you're more of a passive investor, or you're concerned about the impact of commissions, which everybody should be, this is going to be more active. And also, if from a taxation standpoint, if you're doing this outside of your registered accounts, you also got to recognize that capital gains. Further out months provide a greater upfront premium because you're collecting time value. It's much less transactional, but you don't have the opportunity to make adjustments if the shares are moving in your favor, other than just buying it back and rolling out to or up to another strike price. You need to select the approach that meets your objective. So let's look at it from a hedging perspective. My rationale here would be, I want to continue to hold the stock, but I think a pullback is likely. Well, why would I want to hold the stock? It's paying a dividend. I've held it for a long time. I love the company. I don't want to incur any commissions. And I also, maybe it's outside of a registered account. I don't want to trigger any capital gains. Now, one solution is I could buy put options. But put options, we're paying for insurance. It's a great strategy. It leaves upside, but it's going to cost you. So the next question is, well, how the heck can I offset my risk without incurring a cost? What we can do is we can sell an in-the-money call. Now, this kind of seems counterintuitive for those of you that like to, you're used to holding shares for upside. But if the shares are trading at 104 bucks, what I can do is I can go in and I can sell a 94 strike call option and collect $11.85, because that call option has baked into it intrinsic value, right? That's the difference between the strike price and the value that the shares are trading at presently. So we've got a $10 intrinsic value baked into this option contract, plus a $1.85 time value, which means that if the shares drop all the way to the strike price we've written at $94, we actually will collect all of the intrinsic value from the option contract plus all the time value, which means our break-even point on this long stock position is down at $92.15, right? So what that means is I can actually withstand, or this particular position can withstand, a pretty significant, over 10% drop in the underlying shares by selling this option contract. Okay, and what we also want to recognize is, because there's a component of time value associated with this, that also actually adds to my profitability if and when I have to sell. So let's say the shares are trading above 94 on expiration. Well, we get assigned and we deliver the shares. We keep $11.85, which means that we ultimately have earned $105.85, because we basically keep all the premium, all the intrinsic value. We also keep the time value. So we actually end up offsetting this position for a profit, even though we've had to sell it at the 94 strike price. If the shares are below 94, the call option expires worthless, and the investor continues to hold the shares and incurs the losses below the break-even point. Now, again, I know we're pressed for time here, guys, so I'm just going to continue to move through this. This becomes an interesting strategy if you're looking to defer your tax implications in a non-registered account, because I can actually apply the same approach into the new year. What that allows me to do is hold the position into the next tax year while locking in my sale price and ultimately being able to offset any risk until I decide what I want to do from a capital gains perspective. All right, cash flow. This is where we want to generate cash flow. We don't care about the stock side, and we want to know how can we enhance our cash flow beyond dividends. And yes, as the shareholder, you can collect dividends. So in this example, what we're going to do is we're going to sell the share. We're going to own the shares at 104. We're going to sell a 1-month call at the 105 strike. We're going to collect $5.20. That's $5.20 of time value. What this means is that by collecting this premium up front, we've lowered the break-even point to $98.80. So we reduced the volatility on this position, right, which is basically the current share value less the premium collected. If the shares are in the money, which means that the stock is trading above $105, then we deliver the stock, we earn approximately 1% upside, and the option is assigned, I get the profit, and I generate a 5% premium. Now think about this, that's within a 1 month time frame, right? So although many people, and again, keep in mind, gold stocks tend to have a very high option premium associated with them because of their volatility, this is a way that we can generate consistent cash flow without necessarily having to worry about the stock upside while reducing the downside volatility. If the shares are in the money and we want to keep the shares, we roll the position as I demonstrated in the early example to close it. We roll it or close it, sorry, before expiration. If the shares are out of the money, meaning that the option's out of the money, meaning that the stock is below the strike, we just continue to own the stock and we see the options expire at a profit. Now, enhancing returns. Most of you or some of you want to allow for some stock upside, but you still want to know how you can enhance returns on the position. So you may have a target on the stock. You're okay in selling your shares at a particular price, or you're okay reducing your position if you reach that particular price. So what we could do in this example is I own the shares at 104. I want to leave some upside over the next month. So what I can do is I can sell the 115 strike call option. I can collect $2 in time value, which means if I paid 104 for the stock, my break-even point is down at 102 because I get to offset that risk by the amount of the premium that I've collected. I give up the stock upside above 115 and I've lowered my break-even point down to 98.80. All right, so if the shares are in the money and above 115, well, I deliver the stock at the strike, I get 10.5% capital appreciation on those shares, plus an extra 2% premium from writing that call option. If I want to keep the shares, I can simply roll to the next strike and out to the next expiration month and continue to enjoy the share ownership. And if, of course, the shares are below that strike, I continue to own the stock and I can do it all again next month. Now, here's another interesting consideration with this strategy. You may have bought the shares at 80 bucks a while ago and you want to reduce your exposure. So you don't have to close out the entire position. Sell the open 2 calls of your 500 share position, and you can then offset 200 shares at that strike price, getting paid to reduce your risk exposure and maintaining a position on the underlying shares to ideally participate in the upside. So a couple of considerations here before we move on to the questions you have to answer, just as a follow-up to that particular strategy. As of Friday, AEM was trading at $108.30. The options that I'm referring to here expire this coming Friday. So the interesting consideration with that 115 strike is it's only worth now 37 cents. So I want you to think about that. A month ago, 35 days ago, you liked the stock, you owned it at 104, and you said, hey, I like the upside opportunity over the next month, but I still want to generate some cash flow. So you sold that call at 115 strike for $2. If you wanted to continue to own those shares and participate to the upside and make an adjustment, you could buy to close at the 37 cents premium. So you're keeping basically $1.60 of what you wrote originally, and you could then adjust to the 120 strike, or you can adjust to the next month and the 115 strike. Or you can simply just sit back and let that $2 contract that you collected expire worthless, right? So that ties into that understanding of why an option contract or how an option contract adjusts and what the objective is as the option writer. This is a great example of how, as a covered call writer, I could take advantage of the premiums a month ago at a strike price that was further out of the money and subsequently benefit from that passage of time and enhance my return on that position while still, enjoying some of the upside. What do you need to answer before I start answering questions here? Are you focused on generating income and reducing volatility of your portfolio? Or are you focused on capital gains and income enhancement? Or is it a combination of both? You need to figure that out yourself. And as I said, you can build out specific sleeves where maybe you want to allocate all of your capital appreciation strategies to your TFSA. You want to generate all your income generating strategies, and volatility reducing strategies to your retirement savings. It's up to you. You need to build your portfolio first, then apply the strategy. That's what we do here. We build the portfolios first based on market conditions, sector allocation, geographic allocations, which incidentally, we again focus a lot on Canadian positions because, you have to manage that consideration for currency risk as well. So there's some opportunities here to step back, look at your existing portfolio and decide where these strategies can be best implemented. You can use covered calls as part of your investment approach to enhance income and generate returns regardless of what your specific objectives are. You can adjust your selected strike price and expiration date according to your objectives, and you can close out your contracts anytime by buying it back prior to expiration. All right, so now is my opportunity, and sorry guys, I'm a couple of minutes getting to the questions here. Now's my opportunity to answer some of your questions that are flowing through. So first one that I've got here from Cynthia, why rolling? Why not just let the contract close and open a new one on expiring in 1 month after? Well, why you may want to roll is if the stock is close to the strike price and you don't want to lose that stock, you could, much like my example here with that 115 strike, yes, I could let it expire, which I probably would, given that the stock's at 108 and it's a 115 strike. But let's say the stock was at 110. I may not want to risk delivering it next week, in which case I would buy to close the 110 strikes, pay back whatever the market's asking, and then subsequently maybe roll it to the 115 and continue to own the shares. If we look at us having written an in-the-money option, again, I may not want to deliver my shares, tax implications, commission implications, which again, you're going to get when you roll as well. But you may just want to decide to make that adjustment. So hopefully that answers your question. It's all going to be based on what you're trying to accomplish. What's the effect on the next dividend date on the premiums? Well, again, I think it was referenced that it's tough to get into all the challenging, underlying pricing variables associated with the contracts, but stock dividends are priced into the option contract, so that's always an important consideration. Market makers already factor that in. What you need to know as a covered call writer is that if you have the stock and you sold a call, and that call option is close to at the money, and let's say that stock is going to issue a 40-cent dividend, but the call option at the money is trading at 20 cents time value. Well, somebody may come in, exercise their right to own the stock early, give you the premium that you've written and collected, but they're going to take the stock from you and they'll collect the dividend. So you run the risk, and I don't know whether it's a risk so much because you still get your premium and you knew what you were getting into ahead of time, but there is the potential that you're going to have to deliver the shares ahead of dividends, ahead of ex-dividend to somebody who wants the stock and wants the dividend, and you're going to miss the dividend, but you're going to collect the premium. Right, so keep that in mind as you're making your decisions. Again, that may be an opportunity to tie into the last question as to why you may want to roll. It may be close to ex-dividend. You want to roll up and out so that you avoid having to deliver the shares and you collect the dividend at that time. Is it better to sell covered calls further away or close to expiration? Again, it all depends on what your objectives are. The shorter duration, faster the time value depreciation, the more opportunity there is to adjust over the duration of holding the shares to the stock price. but the more commissions you're going to pay. So if you're commission sensitive, if you're not an active investor, you could sell a further out of the expiring contract, collect more premium up front, and just sit back and sort of relax while the shares do what it's going to do. It really depends on what your strategy and your approach is. All right, is there active, okay, you're active and looking for both growth and income inside your registered account. Fantastic, Mohammed. That's, as I mentioned earlier on, you know, this is why you could build out different sleeves within your investment portfolio, and you could apply, you know, let's say out of the money call option writing on more volatile stocks where, you know, maybe it's Shopify, you want to give upside, or maybe it's AEM, you want to give up upside. That's where you could conceivably, you know, do the out of the money options overlay for capital appreciation. It's really going to be up to you. Figure out the characteristics of the stocks that you're holding and then apply the option strategy associated with that. Question here, is there any relation between stock volume and option volume? How do we determine? Absolutely, there is a relation between stock volume and option volume, but as I believe Tony referenced earlier on, it's not so much the volume and open interest, it's what the bid and ask is suggesting to you, and the narrower the bid ask, the better it is from a liquidity standpoint for us to get in and out. The way I reference this, it's like, you know, think about the option spread is the margin the market maker makes on the trade. So think about that like, you know, Walmart or Costco versus a small boutique store. The more traffic, the tighter the margins, because that big box store is making more on sort of, you know, transactions throughout the day, throughout the week, throughout the month. If it's a boutique store with less foot traffic, then they've got to increase their margins to make up for that. Now they've got some wiggle room, and that's why I say you can always go in at the limit price, but make sure you recognize that the higher the volume traded, the more people are looking to buy and sell, the easier it is for the market makers to make a market on the underlying shares. So hopefully that answers your question.